Barbara, when you see rates rising, tech stocks are supposed to be selling off, but tech is actually the strongest sector for the week, up just 0.5%. But still, when the rest is a sea of red, that kind of makes you think, what's going on there?
Yeah, I know. Well, I think it's, with the Fed giving guidance as to an endpoint, it's still a couple years away. In some ways, things have not changed. But I think what we're seeing is that we're more mid-cycle. It's a recognition both by the Fed and what you see happening with the yield curve and interest rates that we are leaving the early cycle stage, which is cyclicals and value and small cap. And we're really getting into the mid-stage of the cycle here. And that really typically rewards growth. And that's where I think you're seeing the Amazons, the growth stocks with real earnings and cash flow. These are the ones that have been performing well, and they have lagged. So I think that's what you're seeing now. This rotation, we'll see how long it lasts, because that has been the earmark of this market this year is lots of rotation. But I think that's what's going on. We're now solidly mid-cycle.
Let's hit the banks, which are the joint worst performing sector today, with energy and the joint worst performing sector this week, along with materials. And there's a very simple reason for the big move lower today, and it is the flattening of the yield curve. There you have the yield curve today. Short end yields rising, long end falling. Mike showed that earlier in terms of the fall in the spread of 2s10s or 530s, whichever way you want to spin it. We've got a snapshot of the week-to-date performance of the 6 biggest banks, pretty pronounced as well. You've got the likes of Citi down double-digit percentage, 11.6%. All of the banks, though, down over 7%. And the added factor to the yield curve move this week, Mike, is we did have commentary for a number of banks. And you got, for example, JP Morgan lowering its forecast for net interest income. And that was before the yield curve flattened its most the last 2 sessions. And the likes of Citi lowering their forecasts for things like investment banking and capital markets revenue. What I'd just say in light of what is a very big move, 11%, for example, for Citi, is that the short end of the yield curve has risen. That itself is good for banks. And in the short term, more important for net interest income than the shape of the yield curve, which is not ideal. It has flattened. And not all banks have lowered the forecast to the same extent as Citi did, for example, in capital markets. Morgan Stanley CEO James Gorman was on with us earlier in the week and was fairly constructive. It's not going to be as good as Q1, the capital markets, but was fairly constructive overall. So I just think that this quarter we might see a bit of market share gains, and it be stock specific as opposed to extrapolating just from 2 banks warning about earnings to all of them. And again, yes, the yield curve is flattened, but on the short end, yields are going up. That's good.
Right. And in fact, if the market really believed that Fed hikes, actual hikes, were more imminent, it would be bullish for banks. That really is a very direct flow through. So I think it is much more also about how banks are the biggest and highest conviction holding of the value basket. So whatever else is going on in the fundamentals, if people are okay, we're pivoting away from that whole category right now. Banks are going to be caught in that whipsaw.
Barbara, what do you think about the banks here? Is there opportunity in the sell-off for you, or is this an area that you want to stay away from if you're thinking we're mid-cycle?
Yeah, well, in full disclosure, I have not participated in the banks. I the MasterCards, the Visas, which have underperformed year to date. But I would not be buying the banks here on any kind of pullback, because I think last year in August, the banks were about half the market PE, and there was good reason. Depressed earnings, there was a lot of uncertainty in the economy, and banks really started to roar this year. I mean, the XLF is up, over 45%. Because of good earnings prospects, loan growth, net interest income, interest rates should have been rising as the economy reopened, but that hasn't happened. Net interest income is at historic lows. Loan growth is at 60% loans to deposits, where it's normally 80 to 90%, and that's really baked in the earnings at this point. I mean, the valuations on banks are 2 to 2.5 times tangible book, so I think they are priced in best case, and I think by year end the earnings may be coming in. So, I mean, there will be some support from dividend increases once they pass the stress test. There'll be share buybacks, but that's not a reason for the stocks to go higher from here. So I'd be very cautious.
Shepard Smith here. Thanks for watching CNBC on YouTube.